maybe I like to talk about the content stuff, but I don't know, the guests probably want to dive into the markets and things like that. So maybe at the end, we'll talk about some of the growth you've had on like your YouTube stuff and your podcast. I mean, I think when we first talked, you were just launching that.
Yeah.
It's been about 10 months and it's been awesome to see. But yeah, I guess just kind of like a recap. We could do the last 12 months if you want. We could do the last 10 months, but just your overall take on kind of the markets and just high level, where's your head at right now? And then we'll dive into some of the topics. And real quick, for those who didn't see the last episode, just quick background.
Yeah, no, well, okay, so real quick, and I appreciate that. Real quick with the background. So, fund manager, somebody that's been in the business for quite some time, built a fairly large social media following, have premium research through the Lead Lag report, and can be quite colorful when it comes to social media when I frame certain dynamics. But I think the summary of whatever background I have can all come to the conclusion, the right of the equal sign, that like you, I have skin in the game, right? As somebody that is an entrepreneur and is dealing not just with investing, but the business side of investing. Now, I'll preface the whole discussion around the market to say that everybody has a bias when it comes to investing, right? Some people are biased towards oil and energy. You know, maybe you're a part of that because of your industry, right? Some people are biased towards being permabulls, being permabears. My bias is always to see volatility. Like, I want to see markets not move up or down, but move up and down where there's a flight to safety sequence, primarily in treasuries that hopefully, my approach can benefit off of. So to that end, I've been very public in saying that I think we're in a pre-election melt-up type of environment. Pre-election years tend to be the strongest of the cycle. I said that at the start of the year. I said that it can be a very strong year, but that there's going to be some of these volatility pulses in between, and that it may culminate in some kind of a credit event. Right? So broader environment that's beneficial towards equities, not necessarily new real after inflation adjusted highs, but a move that gets a lot of people excited, and then a credit event to kind of finish off the bear market. And that point about finishing off the bear market is really where a lot of last year comes into play, because I actually still think we're probably in a bear market. Now, that's not being a perma bear. That's just looking at the reality on the ground, which is to say that you have a very uneven market right now. You've got, as well documented, a few select large cap stocks driving the headline averages. You've got small caps and international really sucking wind against the dominance of the AI theme. And you have not yet crawled out of the drawdown. So you've seen this, I'm sure, Max, right? Like, the media always love to say when the market goes up 20%, the market being the S&P, they say it's a new bull market. It's like, no, first of all, that's not true. There are plenty of bear markets where there are 20% type rallies. And a bear market is only over after you've taken out the prior high. In other words, you only know if you're in a bull market or bear market with hindsight, right? Which means you've taken out the prior peak. Last year was brutal in my world because, in my world, from a rules-based perspective, with my strategy, with my funds, the defensive asset is treasuries. And obviously that failed miserably last year. I've shown that chart many times over, top 20 drawdowns of equities against long-duration treasuries. Last year was the first time in history long-duration treasuries were down more than the S&P 500 in a top 20 drawdown. But that assumes the drawdown is over. So if I'm right that we're still in a bear market, if this is just fooling a lot of people, and you still have another wave lower and a credit event, that means you probably break the October lows. And maybe at that point, treasuries counter, which, by the way, is consistent with recessions, consistent with yield curve inversions. It's funny, it's like everybody forgot that there's still a lot of big warning signs that the economy is about to slow down and maybe decelerate in a negative way substantially. But we're all being distracted by the here's the birdie moment with NVIDIA and AI to realize that not much has changed in terms of how tight credit is still likely to be, given the lags of monetary policy, and how complacent I think most people are because they see the S&P and nothing else. So, long-winded answer, right? But I do think that not to try to provide an alternative take for the sake of providing an alternative take, but I really do believe that this is a very, very deceptive market. Most people are not realizing it.